All right, hello and welcome. Today, we are firing up the furnace on Steel Dynamics, ticker STLD, one of the biggest steel producers and recyclers in America. Now, for any investor out there, that name probably brings to mind a gritty, old-school, cyclical industry. But what we're about to see is that the entire investment case here is being completely reforged. So let's dive right in. So let's just kick things off with a question that really gets to the core of it. What if that company you've been thinking of as an industrial relic is actually a lean, green, tech-driven machine? I mean, a true powerhouse. That's the big idea we really need to wrap our heads around to see the opportunity in STLD. And to do that, we first got to get under the hood of their business model. Because let me tell you, this is not your granddaddy's steelmaker. No way. It is built on a totally different and, frankly, a much, much better technology. And that game-changing tech is the electric arc furnace, or EAF for short. Now, forget everything you think you know about mining iron ore and mountains of coal. An EAF is basically a giant recycling machine. It takes all kinds of scrap metal, we're talking old cars, washing machines, industrial waste, and uses these incredibly powerful electric arcs to melt it all down and create brand new, top-quality steel. This isn't just a different process, it's the very heart of their circular business model. The real genius of the EAF process just pops right off the page when you put it side by side with a traditional blast furnace. I mean, those old blast furnaces are these massive, rigid things. They have to run 24/7, and they come with insane fixed costs. EAFs, though, they are nimble, they're flexible. You can switch them on and off way more easily. They cost less to build, and their costs are mostly variable. In an industry that goes up and down with the economy, that kind of flexibility is a huge competitive advantage. Oh, and by the way, the emissions are way, way lower. Okay, so with that super efficient, modern foundation in place, let's see how it builds up the bull case for the company. What's the engine that has investors so fired up about STLD's future? It all starts with this number, $160 per ton. Just let that sink in. That is Steel Dynamics' production cost advantage over the industry average. Think about what that means. For every single ton of steel they make, they have a built-in profit cushion of $160. It's the perfect example of how their operational skill translates directly to the bottom line. And here's even more proof of just how well they run their business. STLDD keeps its mills humming at a 91% utilization rate. The rest of the industry? They're down at 76%. Now, why should you care about that? Well, because a fuller plant is a more profitable plant. It means they're grabbing market share and squeezing every last drop of cash flow out of the expensive machinery they own. Now, being a low-cost producer is fantastic, but you still need customers, right? And right now, STLD is staring at a massive wave of demand. You've got billions from the Infrastructure Act going into roads and bridges. You've got a boom in new factory construction, thanks to all the reshoring incentives. Then you add in all the steel needed for wind turbines and solar farms, plus the advanced steels for these new, heavier electric vehicles. And what you get is a set of powerful, long-lasting demand drivers right here in their backyard. And on top of that amazing market, the company isn't just sitting back. Oh no, the bulls are pointing to two monster growth projects. First, you've got the ramp-up of their brand new state-of-the-art steel mill down in Sinton, Texas. And second, a huge, almost $3 billion bet on diversifying into recycled aluminum. I mean, these are not small tweaks, people. These are transformational moves designed to massively boost their earnings for years to come. Okay, an incredible cost advantage, booming demand, these huge growth projects, it all sounds a little too perfect, doesn't it? So what's the catch? Because you know there's always a catch. Every investment story has two sides, and as an investor, you absolutely have to understand the risks. Which, of course, brings us to the bear case. This is the reality check. It's that dose of healthy skepticism that we need to balance out all of that incredible optimism. For decades, the biggest fear for any steel investor was pretty simple: a recession. I mean, steel demand is tied directly to the health of the economy, so a downturn could just crush volumes and prices. And look, that risk has not gone away. But for Steel Dynamics, right here, right now, the number one risk has actually shifted. While the economy is always going to matter, the bigger question mark has become internal. It's all about project execution. Can this company actually deliver on these massive, company-altering promises they've made? So when you boil it all down, the key concerns for the bears are pretty clear. Yeah, the economy is still a risk, and cheap steel from overseas is always a threat. But the real spotlight is on execution. That big Sinton mill ramp-up, it's already hit a few speed bumps. And even more critical, launching a multi-billion-dollar aluminum business means jumping into a totally new and super competitive industry. Their steel playbook might not work there. It's a really high-stakes gamble. So you've got this tension, right? You've got this powerful bull case on one side versus some really significant risks on the other. The key to figuring this out is to look at management's playbook. I mean, how they choose to spend their money, their capital allocation, tells you everything you need to know about their priorities and their confidence. And you really just have to follow the money. Over the past 5 years, they've generated almost $13 billion in cash. And where did it go? It's fascinating. It's an almost perfectly even split between reinvesting for growth, that's the new mills, and buying back their own stock. A little slice goes to dividends, and almost nothing goes to buying other companies. The signal here is crystal clear. They believe the absolute best investments on planet Earth are in their own operations and their own shares. And let's just pause on the sheer scale of that buyback. $6 billion. By taking that much stock off the market, management has seriously reduced the number of shares out there. That means each share that's left gets a bigger piece of the profit pie. It is a powerful, tax-efficient way to reward the people who stick with them for the long haul. Okay, we've looked at the efficient business model, we've seen the bull case, we've weighed the bear risks, and we've checked out management's playbook. This brings us to the final piece of the puzzle, and it's the ultimate question for any investor. After all of that, is the stock actually a good value today? Well, if you look at its competitors, STLD seems pretty reasonably priced. Its price-to-earnings ratio is floating around 17, which is a good bit cheaper than its main rival Nucor, which trades at 25 times earnings, and it's valued way more highly than the struggling old-school producers. So, relative to the competition, it really doesn't look too expensive. But, and this is a huge but, this is where the plot really thickens. When you compare the stock to its own history, it suddenly looks very expensive. Its current PE ratio is more than double its 5-year average. So what does that tell you? It tells you the market is definitely not valuing SSTLD like a boring old steel company anymore. It is pricing in a ton of future success from those big growth projects. And this really gets to the heart of the matter for anyone looking at this stock today. The fact is, for this company, the investment case has evolved from primarily predicting the steel cycle to assessing project management capabilities. The bet on STLD today is no longer just about timing the economy. It is a bet on this specific management team's ability to pull off these incredibly complex, multi-billion-dollar projects. Which leaves us with the final, critical question that you, as an investor, have to answer for yourself. At a valuation that's more than double its historical average, is all of that incredible future growth from Texas and this new aluminum business already baked into today's stock price? That really is the billion-dollar question.